Good afternoon. This is Ken Long from Tortoise Capital with a review of the daily trading plan for October 15th, 2011. We have a market that is in bearish normal conditions. On an annual basis, it's at 50 out of 100 using weekly RSI, so right in the middle of the annual trading range. On a 10-day basis, it's at 100 out of 100 using the 10-day NDX, so we're at the upper limit of overbought, getting ready for a breakout. Percent stretch above the 200-day moving average is at minus 3.21%, so that's coded yellow, meaning the market has been healing over the last week on a week-over-week basis and getting ready to enter sideways if we get just a little bit more improvement. It's still bearish, but we're right on the boundary to sideways. The 5-day slope of the 50-day moving average has improved to minus 0.20 slope. That's above average and therefore rated bullish. If that goes positive, this will be a confirmation of bullish intent. ADX 14 is declined to 15.7 based on the buying pressure of the last week. So it is well postured for either a bull or a bear trend to develop from this low ADX 14 reading. Bulls are actually in charge a little bit, as you can see on the southwest corner here where we have the ADX indicator. So the conditions for the beginning of a bull or a bear have been set. The next move out can be a multi-week move. ATR percentage is at 2.49%. You can see on the ATR indicator here that we're in the high end of normal, but the declining volatility is actually bullish. Using the 30-day gap stat, what we can see is 15 times in the last 30 days the market has gapped down. 10 of those 15 days after a gap down, it has reversed up for an average follow-through of 1.44%. 5 times it has gapped down and then closed lower for an average follow-through of minus 1.0%. So the gap down and reverse and close higher has been the higher probability and the higher payoff move, and so we'll be eager to see that happen in the next week. That's the favorable move. 15 times in the last 30 days it has gapped up. 6 of those times the gap up has reversed to close lower for an average follow-through of minus 1.45%. 9 times out of 15 in the last 30 days it has gapped up and then continued to gain an additional 1%. So an upward move after any gap has been the more probable move, but the reversal play in either direction has been the better move on a payoff basis. So gap down and reverse to close higher has been the biggest payoff, and the gap up and reversal to close lower has been the higher percentage payoff as well. So as it stands right now, gap and reverse is the lucrative play. You can see the 10-day NDX time series. We have been overbought for a few days now, and we know that if the bullish trend continues, it can stay overbought for a considerable period of time. No signals on the long side in overreaction, but just about everything in the world signaled overreaction to the short side. Because of the strength of this last bullish move the last couple weeks, I would recommend waiting to see failure below yesterday's low before I went short if you have concerns about risk management on that side. No signals in channeling, with only the NASDAQ 100 above its 200-day moving average. You can see the daily pivot points calculated in the usual way for reference. In the 10-day max pain, the things that have lost the greatest on a percent basis in the Dow have been Bank of America, JP Morgan, American Express. So 3 out of those 5 have been banks or financial services, and we know from the world market model that XLF has been horribly oversold. So on a one-day dead cat bounce basis, financial sector is on my short list, and those 3 targets are on my watch list as well: Bank of America, JP Morgan, and American Express for high payoff one-day trades. Boeing and Coca-Cola are also 10-day max pain. I'm interested in Coca-Cola because it has been a relative strength leader as a member of the consumer staples. So here's a chance perhaps to buy a consumer staples large cap leader at a moment of value. In other words, Coca-Cola is on sale. In the ETFs, 10-day max pain, it's the VIX, the treasuries, regional banks, the dollar up, and another ETF for regional banks. So everything is pointing to financials being dramatically oversold and underperforming, and may be eligible for a catch-up rally. No signals to speak of other than 551W in treasuries, and then channeling signals in treasuries and the VIX. The stealth leaders on a sector basis are all the usual suspects: industrials, healthcare, and consumer staples in the ETFs. And then among the large caps, Procter & Gamble, Johnson & Johnson, Pfizer, Merck, and Home Depot. Again, XLP, the consumer staples, is a way to play all of those stealth improvers. That was one of two ETFs that were on the ETF 30 strength list, utilities being the other one. So XLP ought to be the focus of your attention. If you're not sure which of those leaders to get on board, XLP is a good way to play that as a proxy. Moving on to page 2, the Dow Tactical. That says all the things we just said. Max pain range compression candidates: Procter & Gamble, American Express, Coke, AT&T, and Walmart. I'm interested in Coca-Cola on this one because even though it has lost the most, it was not a percent loser on Friday. So that says that perhaps the pain is already over, and in fact it was up 0.7 on Friday, and we would perhaps have 1 day of momentum to build on. So I'm going to have Coca-Cola as a mechanical entry on the upside on that basis. About half of the Dow stocks were in doji status on Friday, meaning they're at a natural hesitation point, and so I'm concerned about them being at the end of the good long run rather than at the start of the next one. If you already own those positions, be prepared to preserve profits from the last 2 weeks. Looking at the ETFs next. Max pain range compressions in VIX, treasuries, natural gas, gold, and Japan. Gold is of interest here. It's pulled back from above 180 to 163. If equities reverse next week, early next week as a profit preservation, gold should then therefore do well. Natural gas is of interest. It's the energy sector. It had a 4% gain on Friday, and at $9, it's still at a favorable entry point if we see a longer-term trend unfolding in natural gas. A handful of dojis, and then you can see the couple of channeling signals for VIX and treasuries, which got smoked on Friday. The VIX was down 5%, and thus creates an investable moment. If we see weakness in the equities, then the VIX is postured very favorably for a short-term intraday tactical trade. Energy sector was a big winner on Friday, with XLE giving a 4% intraday gain, and so we'll be watching for potential follow-through there. And in the energy large cap stocks like Chevron, ExxonMobil, Devon Energy, and Valero Energy. Taking a look at the frog status, I'm going to zoom in a little bit so we can see those that are highlighted in green are exceptionally froggy. Those are all above 3.0 frog quality number, so they're going to be leading candidates for frog trading on Monday. The Dow 30s are in pink, the ETF 30s are in blue. So among the stocks, it's Caterpillar, Verizon, Walmart, Pfizer, Alcoa. As you know, I love me some Alcoa. His standard deviation is 0.14. His magic number is therefore 14 cents. Those are all frog quality numbers greater than 3. so they're candidates for trading. For those of you playing at home with the frog on the small caps, we're looking for IWM, and its magic number is 80 cents. Frog quality number of 2.8. It's not quite 3, but that's good enough to trade. 80 cents is your standard deviation number in small caps. Inside the spiders, looking for SPY here. Its magic number is 98 cents, so a dollar. A dollar move is the standard deviation lens for the spiders. Its frog quality number, excuse me, is lost it. Where is it? 2.7. So a $2.70 move in the spiders would be the noise limit. I'm sorry, that was the frog quantity. Yeah, it's a dollar for the standard deviation. $2.70 would be the normal move. Okay, moving on to the signal to noise ratio. Again, this is the directionality of intraday moves. When we consider the difference between the open and the close and compare that to the range, how much of the move on average is directional? Those in the green are exceptionally directional. So when we see those moves using frog techniques, these are ones that have strong directional follow-through. I like what I'm seeing here with the NASDAQ 100, financials, and Disney. Those say if you can get the high or low of the day pinpointed, the directional move can be large. That makes it also a good frog quality candidate. So NASDAQ will be of interest to us tomorrow. The fail stat again measures the average move from the open to the low of the day. So I'm going to highlight just IWM here. The average fail has been $1.01. So what that suggests is if there's after the open, it will sell off on average $1 to the low of the day at some point, and then make a reversal. So if we see a gap down and a sell-off of $1 and then the potential reversal, then we have reason to believe that that was actually the low of the day, and then we can start playing for a range stat move above. If it starts selling off more than that, we have an indication that perhaps it's going to be a directional down day. So that's how you use that reference chart. Taking a look at the market mosaic indicators here, we have the slope of the regression line is basically flat, and with R squared at 0, we have a perfectly chaotic potential turning point has been established here. This would be a natural place for the bearish price action to start reversing and moving north. You can see in the time series we're right at the 180-day average. No directionality indicated here, therefore a perfect place for the next intermediate term to start. Zooming in on the 30-day time series, you can see that the regression line slope has crossed its 10-day moving average to the upside, so there is the bullish move is slightly favored here if that's the direction that it moves. You combine that with a low ADX reading, and we are perfectly positioned for the beginning of a next intermediate term trend, and the weight has to go to the bulls right now. The percent stretch, you can see that we've come one standard deviation off the low, and if we get a bull move here, it would be within the realm of normal over the next 4 weeks to see a retest of 137 on the upside, which would be a 10% gain, and so that's the dimensions of a normal bullish trend if it were to develop from this location. Moving on. Just for reference, I've included the intraday range stat percentages for all the usual suspects, the 30 Dow and top 10 or 15 ETFs of the world market model for your reference. I won't go through those. I've included the X-day holding period statistics here. I just want to zoom in and take a look at SPY. It's had an extraordinary move over the last 10 days. It has gained 11% in the last 10 trading days. That gives it a z-score of 2.6. So on a historical basis, that almost 12% move is more than 2 standard deviations above average of the last 5 years. So we can classify the last 10 days as an extraordinary move up, and therefore I'm prepared for it to reverse here as part of normal business. If it reverses, the next move down could easily be minus 5%, and if it were to find support there, that would be consistent with a bullish tendency where it's moved up, made a slight pullback, and then resumed. So a 5% downside is normal after an extraordinary upside move. So just be prepared for profit preservation, and then be prepared for a resumption of the bull should that 5% retracement hold. May you be born in interesting times. We're in interesting times right now. Looking at the Dow 30 quality report next. And what I look for is a divergence between the quality score from 2 months ago and the quality score of this month, and that divergence is measured in the first column. So the ones that have improved the most 2 months ago versus the last month are IBM, Intel. Those are the exceptional improvements. That's part of the contributors to the outsized strength in technology. As an example, IBM, its quality score from 2 months ago was minus 1.08. Its quality score over the last 30 trading days is 2.48. So it's improved 3.56 quality number reports. That's exceptionally good, and therefore it's coded green. Same thing for Intel. That has had the biggest improvement month over month, and that divergence is 4.91%. So that's where the strength in technology is coming from, and I would look for that to continue on. So we might want to look at IBM and Intel for follow-on. I especially like Intel at $23 a share, and with the current system quality number of 3, right now Intel at 3.02 is the strongest member of the Dow in terms of system quality number. If you listen to the leaders on 30-day quality scores, it's these that are green in the first column: Cisco, Walmart, Intel, Verizon, and IBM. So tech heavy and staples heavy. Moving on now to the ETFs, the same idea. Those that have improved the most are highlighted in green in the first column. That's NASDAQ 100 and XLK, the S&P 500. Those that are suffering at the top, gold, silver, and commodities, have degraded the most. And this shows you just how quickly the truth can change month over month. 2 months ago, gold and silver, let's just take a look at gold. Gold had a system quality number 2 months ago of 2.66 and now has decayed down to minus 1.36. An extraordinary sell-off in gold, and therefore I believe gold is on sale. And if we see weakness in the equities, I'll be prepared to buy gold at the first sign of strength. Same with silver, and then with the commodity and agricultural commodities as well. Long-term treasuries, you can see how they've suffered. They've dropped off 1.46, and that looks like profit taking in that area as well. So that's the quality reports for the Dow and the ETFs. Just for your relative reference, the gap statistics for the big fat indexes, stats are provided. Daily, weekly, and monthly pivot point calculations for the big indexes. Alpha stat score, what I would observe here is that commodities are postured for potential gains, having improved in the last couple days relative to the S&P. That has corresponded with a decline in volatility in the spiders. The last couple days have been like dojis as it has approached resistance at 122. while gold and the commodities have begun to improve, and that accounts for their alpha stat improvement. Safe zone signal, commodities got measurably stronger. That was the only one using the safe zone strategy. So I would be ready for a continuation of performance in DBA, especially if equities get weak. I'll be looking to get on DBA early. As we remember, DBA, the grains ETF, is extremely directional. If you can catch that one early in the day, you get a very nice intraday trade available. So we'll be watching DBA in the morning. Correlation coefficients between the major indexes for your reference. I won't dwell on that. And that concludes the daily report review. Market is poised at a natural resistance point. It's been very strong resistance at 122. If it breaks through, the next move up could be a sharp 3 to 5% intraday, and the next serious resistance at 127 and then 137. Retracement here, the next downside target is 5% lower to about 117. That would be consistent with a emerging bull. So be prepared to preserve your profits, but then you may have a buy on dip opportunity when the S&P, if the S&P gets down around 117 and holds. Technology and staples are the clear leaders inside the U.S. The U.S. is stronger than the world. Financials are in max pain condition both on a sector basis and stock basis, and so if we get it wouldn't surprise me to see a nice one-day pop in those, so be ready for that tactical opportunity. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry. See you in the chat room.